Thank you very much, and thank you to The Economist for having me here. Just by way of background a little bit, because I think it's informative, and then I can make some comments which I think are going to be complementary to what Bob was talking about. I come from a distressed background, and so my introduction to Greece was through the crisis. And we view it as having been a distressed market, obviously, for the last 10 years. And when you follow distressed situations, you see these, drawdowns and then these recoveries, and normally that happens relatively quickly, and in Greece for various different reasons, some of them macro, more European related, and others more endogenous to Greece. It's taken quite a long time. We think that we're at the end of that process right now. And I'd like to talk a little bit more about the public markets as opposed to private investments, as Bob was talking about. And so I want to tell a story about 2018 and 2019 because I think it's instructive about investing in Greece and investing in the region, and also how global investments work nowadays. In 2018, if at the beginning of 2018, there were a few signposts that you would have looked at to see whether Greece was going to be successful by the end of 2018. The Greek banks were going through stress tests. The four systemically important banks were going through stress tests. And Greece was meant to exit the program with the Europeans later on in the year. And then Greek economic growth was meant to begin picking up finally after years of being sort of flat on its back. And those three things happened successfully for Greece. So if you had said at the beginning of the year, those three things, check the box, check the box, check the box, you would have thought, well, the Greek market will do very, very well this year. And in fact, the Greek market did horribly last year. The Greek public equity market did terribly. The bonds did quite well, actually. But so then the question is, well, why did that happen? And the reason that happened was because of the way global investments happen nowadays. So even though good things were happening in Greece, money moved away from Greece because Greece was sort of the Venn diagram of disfavored themes for 2018. So Greece was an emerging market at a time when Turkey was falling apart or doing whatever it was doing. Argentina, the Argentine investment case came undone. And emerging markets generally, money was flowing away from. At the same time, it was a European market. Money was flowing away from Europe more generally. Money was specifically flowing away from European financials, where European financial indices were down 30% last year, 3-0. And Greece is a heavily financially oriented market. And then finally, peripheral economies were clearly affected by what went on in Italy last year, and beginning with the new coalition government in Italy and fears about that. And so the Greek market did quite poorly. Now you fast forward 2019. So what do we see as we're beginning 2019, getting into the middle of it? So money has begun to flow back into emerging markets, which has been supportive of Greece. But the main thing that you look at, I think, is what are the catalysts or guideposts that we can look at for this year, which may be more significant than last year. And we point to two very large ones, one of which is the key one that everyone knows is coming, which is elections this year, and the second one is the cleanup plans for the non-performing loans. Let me start with the first one because I think these are key. So the good news about the huge drawdown in the Greek market last year is it very much focused the attention of the Greek government, Greek regulators, European regulators on taking a more proactive approach to reducing the issues in the Greek banking market. And so there are now three separate plans which would not have happened, I believe, but if not for the market turmoil in the second half of last year, which are now either already legislated or being legislated or may be legislated, which will have very significant, they're very significant tools for the ability of Greek banks to reduce these non-performing loan portfolios. So that's point number one. Point number two is elections, and I'm going to be completely apolitical here. I'm just going to say that I think that markets would be looking for whatever the new Greek government is to change the fiscal policy mix, which has, so Greece is fiscally fixed now after all these many years. They're running 5+% primary surpluses in Greece, required to run 3.5% primary surplus. So the question is, how do you take that fiscal breathing room and space and use it to encourage growth and encourage investment? Greece is lacking for investment. It's running 10 percentage points below the European average in terms of percentage of GDP and fixed capital formation, and that's the key to growing Greece going forward. It's private investment, it's foreign direct investment, investment in public markets. All these things will drive Greece, we believe, going forward. And so what we would love to see, whatever the next government is, we would love to see them implement pro-growth, pro-business, pro-investment policies, and those will include specifically tax policies which invite investment, so reduction of corporate taxes, reduction of property taxes, reduction of various different consumer-heavy taxes like the VAT, and then real commitment to long-term reform. And this goes all the way, it runs the gamut from the legal system and the court system to just simple administrative aspects and truly deeply reforming the Greek government bureaucracy. We think those are two things that are really, really important. And we believe that as these non-performing loan plans progress this year, and as we see what the next government is going to do, and if it is sort of, again, check the box that the government is going to do these things, we think that growth in Greece will be very, very significant going forward. It's very difficult. I know, Peter, your economist says 1.8% for this year, but obviously these macroeconomic models, they're highly dependent upon confidence and what people think. And so we believe that with a real resurgence in confidence in Greece, that growth can significantly outperform that, and that if you have the reverse, obviously, then you'd have the reverse effect. So these are the things that we're looking for in 2019 and going forward. And with that, I'll turn the microphone over.
Thank you.